Okay, guys, we are live on the webinar. I want to thank each and every one of you for being on the webinar as individuals continue to log on to the webinar. Now, I want to say, hey, Lamont, Lisa, Taylor, I believe it is, Shanita, hello, how you doing? Kimberly, Michael, how's everything going? Greg, Sheila, Lisa, hello Lisa, how are you doing? We have Myra, Karen, Sylvia that are already on the webinar. Currently, you can chat on the webinar. We're going to turn the chat feature off, but we will have the questioning and answering live for you guys to be able to answer any questions that you may have. So we will be turning that on, but that is already turned on. So this is a live questioning and answering webinar. Welcome, Robin. Welcome to the webinar as well. Vivian, Asher, welcome to the webinar. Guys, go ahead and grab a pen, grab paper. Make sure that you have your volume turned up so that you can hear clearly. Leon, welcome to the webinar, sir. Shika, welcome to the webinar as well. Individuals are still coming on. I want to give them a little second to get on the webinar. Again, the chat field is about to be turned off, so let's go ahead and turn the chat field off. Right now, the chat field is turned off, but the questioning and answering field is on. Okay, the question and answering field is indeed on. Okay, so we're going to go ahead and get started with this webinar. I am excited to be able to do this webinar for you this afternoon. It's all about major tax breaks, guys. It's all about the major tax breaks. But before I get into the details of the webinar, let me introduce myself to some of you that do not know me. My name is Terrence Hawkins. I am the CEO and founder of Hawkins Accounting and Tax Service, just located here in Charlotte, North Carolina. My wife and I have been in business for 20 plus years. We're so excited about that we have made it this long. But I've been doing taxes since I was 15 years old. I am 44 now, about to turn 45 in a couple of weeks. I started doing taxes with my father. My father has been doing taxes all my life, and I clearly remember he was doing taxes during tax season, and I wanted some shoes. I wanted some shoes, and I go up to my dad, and the shoes was only $19.99 at that time. And some of you can say, hey, that's a big difference from the cost of shoes today, and I am with you. But that's all I needed. And instead of him giving me the $20 to go out and get my shoes, he actually gave me one of his clients' kids that worked at one of the fast food restaurants. He gave me their W-2. He also gave me a tax book and a tax form. You know, back then, we used to have to go to the library to get the forms. Things wasn't done on computer. You had your calculator, and you had your form, and you had your pen, and you needed to do your taxes. So he gave me that and sent me into the back room. That was my first lesson, just going to the back room and kind of figure it out. You know, I came back sometime later, not sure exactly how long it took me, but I came back to him and I presented the information. And of course, guys, it was all wrong. Do not think that I did it on the first time, because I did not do it on the first time. But it was all wrong, but he gave me a $10 bill. See, I remember that. He gave me a $10 bill, and I was like, hey, a 15-year-old with a $10 bill, Dad, do you have another W-2 so I can do it again? But that started a lot of the different lessons that he taught me during my education of learning how to do taxes for individuals. Since then, we have educated tens of thousands of individuals. We have done seminars, we have done webinars, we've done group meetings, we've done home meetings all throughout the country, saving individuals millions of dollars in taxes collectively as a unit, and we are so happy of that. We specialize in tax strategies, and that's all about tax planning. Doing what you're doing now is not tax season, and you're learning how to minimize your taxable income so that you can pay less on taxes. So we specialize in doing those things, putting plans together for individuals. I am an enrolled agent. That simply means that I am authorized to practice before the IRS. The IRS only have three groups of individuals that's able to practice before them, that are your attorneys, your CPAs, and your enrolled agent. The difference is the enrolled agents have to take a series of tests with the IRS. We have to take three of them now, and those tests we have to score a certain level on the score. And it's all about tax, strictly tax information, for individuals to corporate and partnership to ethics. And we also have to have a certain amount of CE credits every single year to remain an enrolled agent. But we are able to practice before the IRS for our clients in all 50 states by being an enrolled agent. So that's just a little history of me for those that do not know me, okay? Let's talk about why we are here. Why we are here. We are here because taxes are bleeding you to death. Taxes are bleeding everybody to death. There's a lot of talk about taxes. And since this is an election year, of course, every election year, individuals talk more about taxes. Who's going to reduce taxes and how they're going to get the money to do this and that, who's going to get the credits. And we pay attention to it because we know that every day, something that we are paying for, we have to include taxes to it, because it's not just federal tax or state tax via income tax. Even when we go to the grocery store, we are paying sales tax. I can clearly remember the first time my son found out about sales tax. We allowed him to go and buy something from himself. It was at Best Buy. He had some little games that he wanted to purchase, and he was finally using his money. And he thought that he had the right amount out. And then when the cashier told him a different amount, he looked at me funny, and I was like, it's because of taxes, So taxes are bleeding us to death because everything that we're paying for, we're doing sales tax, we're doing gas tax, we're doing property tax, okay? We're doing a lot of things with taxes, including our income tax. And I want you to start thinking about the first time that you saw the word FICA on that paycheck. When was the first time you saw the word FICA and you was like, what is FICA? Even though it's not a tax, but it's what Social Security and Medicare. Now, let's go with the importance of why we're here. The importance of why we're here is because of how much that we have to live off of after we pay our tax. I want you to look at the screen and then kind of figure out where you fall. Okay, the average person income salary in the United States today, the average is $53,000 gross, $53,000 a year gross. And in this chart, if you make $36,000 to $87,000 a year, you're in the 25% tax bracket. If you're making $87,000 to $183,000 a year, you're in the 28% tax bracket. So look at the screen and kind of see where you are. If you make $183,000 to $398,000 a year, you're in the 33% tax bracket. 398 to 400, 35%, and 400 and above, 39% tax bracket. Well, if the average is $53,000 a year, those individuals are in the 25% tax bracket. Now, that means that your estimated tax burn is about $13,250. That simply means, guys, if you're average around $53,000 a year and you're not doing anything about it, you're getting taxed on 25%, which is your tax bracket. You're paying about $13,000 a year in taxes. So that really means that you're taking home around $39,000 a year. That's your take home pay. Okay, that's your take home pay, $39,750. And Terrence, why is that so important? Why do people feel the burn of that? They feel the burn, guys, because, hey, numbers do not lie. Because the average household expenses is about $4,200 a month. That's your rent, your mortgage, your utilities, the gas, your telephone, your miles, your vehicle, your grocery, your kids, all that. The average is about $4,200 a month. Now that comes to about $50,000 a year. That's your household expenses. So if your household expenses are around $50,000 a year, your bills add it up, and you're only bringing home $39,000 a year. What is that? That means that you are about $15,000 negative, upside down. Your bills are more than your take home pay. And that's what we're experiencing right now as a country. And I'm sure you look at that and say, yeah, I kind of feel that. Because we already know that most people need an average of $500 to $1,000 in additional income a month. Studies have actually said that if individuals had an additional $500 to $800 a month, we would have stopped a lot of foreclosures, a lot of bankruptcies, okay, a lot of repossessions. We would have stopped a lot of those things with just $500 to $800 a month. And it's all because we're taking home less money. And then if we try to take home more money by changing our W-4 forms at our job, when we get the bonuses, we don't want them to take any taxes out and things of that nature. Then we fill out our tax return and we found out that what? Now you owing the IRS. And you owe the IRS the tax plus the interest if you cannot pay the whole thing off. So it's like, wow, what can I do? What can I do about this number? Well, let's talk about how most individuals try to fix this. You see, most individuals say, you know what? Let me go out and get a part-time job. I must have a part-time job now. I must have a part-time job, whether it's 10 hours a week, 12 hours a week, 15 hours a week, something to help me to just pay these bills, just some extra money to actually do certain things. Most people are trying to get a part-time job during the holidays, things of that nature. Sometimes that doesn't work. They'll do it because we're taking our time away from home. Some of us have kids that are younger, maybe single parents, don't have the time to get a part-time job, or we're working a full-time salary job and it's no time to do part-time, especially if we had kids and children. So another group said, you know what I do? I refinance my home. I refinance my home. So you're trying to get an extra money out of home. But here's the thing, that's just one time. Yes, you can refinance a home. It's going to cost you to refinance your home. You're going to get some money, or you're going to pay a little bit less on your home. But still, you're like, I need some extra money. That just hasn't worked because individuals have tried that already. Those that are able to refinance, meaning that they do have equity in the home and the good credit score, then they can do that. But what if you don't even have equity in your home? In 2008, there was a lot of individuals that, the value of the home, it went down. So that's not really working. And the third one, most people say, hey, you know what? I will work more hours at work now. I put in some more hours. Well, that's hard now because a lot of individuals are not even able to work more hours. Why? Because the job's saying, do not go over overtime. We're not paying any overtime. I talked to another young lady this week that said the same thing. I used to get a lot of overtime, but now this job's saying no more overtime, can't work more hours. So then individuals said, what I do is I get some credit cards and I use the credit cards. Well, when you look up that stat, you see that America is pretty much living on credit cards right now and they're not getting ahead. So that's not going to work. Or take out personal loans. Worst case scenario, let me take out a loan. Some people took out those things called student loans and they didn't even use it for school. They used part of it just to live off on. Okay, that's happening right now. So this is not working for individuals, but this is what most individuals are doing to try to fix the negative part of the take-home pay. Now let's go over how millionaires end up fixing this. Because I do believe that you need to follow a good person that's doing things right. If you see some success, follow them if they're doing it illegally, right? Where the millionaires are saying, this is what we do. And this is done by an interview of an awesome gentleman, Rich Dad, Poor Dad. Actually wrote the actual book there and stuff. And I can tell you, Robert Kiyosaki has been all around the world teaching individuals how to get out of debt, how to get an extra income, how to invest in real estate and all that. One of the interviews that he gave years ago on the Oprah Winfrey show talked about the three things you need to do. Number one, set up a home business. He said, set up a home business. And everybody's like, I don't have time to set up a home business. I need to set up a home business. but he talked about setting up a home business for the purpose to control your own taxes. Number two, you see, he realized that there's a lot of different tax deductions in a home-based business that you're not getting right now as a W-2 employee. So if you set up a home business, now your taxes are a little bit different. You see, business owners have a different type of look at paying taxes. If you have a W-2 job without a business, what's happening is when you're working and off that gross pay, your taxes is immediately taken from you. Okay, it's controlled. It's control. You have no other deductions to help you. But if you have a home-based business, you have some control because you're paying taxes off of the net profit. After all of the expenses are done, then you're paying taxes on that money. And then he said, after you start controlling your taxes and paying less on your taxes, then you take the extra money that you have and invest, erase the debt that you have, or you can save it. It's just a better way. It's just a better way. Well, I'm here to tell you, after all the research and the studying that I've done with the IRS code and with the IRS and different seminars and all around, I'm here to tell you that if you do not have a home-based business, you are paying way too much money in taxes. You're paying way too much money in taxes. You see, the Congress has approved major tax breaks specifically for those who have a home-based business. Again, Congress has approved major tax breaks. I'm talking tax breaks. I'm not talking about loopholes or gimmicks and things that, no, legitimate tax breaks specifically for those who have a home-based business. Now, some individuals will be like, why in the world would Congress ever do that? Well, there was two major reasons. The first objective that the Congress was trying to do is, hey, they want to stimulate the strongest segment of American economy, the small business. We do see that now on the presidential election trail right now. We do see that right now. Individuals are talking about small business, because they know small businesses will what? Boost the economy. Small business. So they want to say, hey, what's the good thing is to get a lot of small businesses out there so we can boost the economy. That's the first objective. But here's the main objective. And this is the biggest one. They want to encourage every taxpayer to have a home-based business because it provides the ideal safety net in the times of economic downturns and layoffs. Because, you know, people need a safety net. In 2008, people needed a safety net. And they're saying in times of economic downturns, that was the downturn in 2008. And then what happened? A lot of individuals got laid off. And you can tell individuals, if they would have had some type of extra income, $1,000, $2,000 a month in a home business, they could have, you know, saved some things. I know some individuals that did lose cars, that did lose houses. Unfortunately, some of them did lose marriages. So Congress is saying, hey, if we encourage everybody to have a home-based business, that if things do happen, if they do happen, they can take that part-time home-based business and they can work it hard if they're laid off and it turns out and ramp that up to a full-time income. Therefore, then individuals didn't need what? Unemployment. They didn't have to go and get unemployment. They can take that part-time and ramp it up to full-time and they're okay. And because of that, Congress said, we're going to encourage them. And how do they encourage them? They encourage individuals with tax breaks. That's how Congress encouraged individuals to do certain things. It's all because of tax breaks, tax credits, tax deductions, the refunds. Okay, that's what they do. So let's qualify for a home-based business first, because you can't just say I got a home-based business and take a lot of tax and deductions and tax breaks, because Congress objective is for individuals to be able to start part-time and being able to make that full-time if they're going to give you a tax break. Okay, now in doing that, you know, Congress said you must have, number one, a profit intent. A profit intent. That means you got to start a home business with an intent to try and make a profit. It didn't say that you have to start off making a profit. You have to try to make a profit. You see, Congress understands that businesses sometimes take a little while to turn into profit. Whether somebody's going to get a small home-based business or they're going to get a franchise, a corporation, depending on what you invest into the company, it may take you a little while to start making a profit. But they're saying as long as you're trying to make a profit, have a profit intent, we're going to classify you as having a home-based business. That's the first thing. The next thing that individuals must do is you must work your home business on a regular and consistent basis. A regular and consistent basis. You have to work it. You have to say, hey, if you're in something that requires selling something, I have to see you doing some selling, doing some samples, explaining your products, explaining your services, purchase your services, purchase your product. You have to do something, education for the business, anything to support that business to try to have the intent. Now, here's the thing that a lot of individuals are saying, Mr. Hawkins, I don't have time to do a home business to even try to save money on my taxes. I just don't have the time to do so. Well, Congress has said it's only an average of 3 to 5 hours a week is what they're looking for. Now, that's less than going out and trying to get a part-time job. So, and I said the average of 3 to 5 hours a week, because some weeks you may not be able to work your part-time job. You may not have time to work the part-time job, but did you work it 1 week 10 hours, 1 week 20 hours, 1 week a weekend? Even individuals that have a home-based business, if they were attending a webinar like you're attending the webinar now, that's considered regular and consistent basis because they're doing something to educate themselves for business purposes, which is saving money on taxes as well. So an average of 3 to 5 hours a week. Even some of the individuals that I'm coaching and I'm teaching, I'm saying, hey, how many hours do we watch the TV shows? We have the show Scandals, we have Empire, we have all of those things that are playing, and we make sure we're watching those. Football is coming back. One football game. Hey, give up one football game a week. That's an average of 3 to 5 hours a week on average. It's worth it when you're talking about the money that you can save on taxes. Okay, so work it on a regular and consistent basis. And then here's one here. This is the one that most individuals do fall apart on, okay? But it's also one of the most important. Proper documentation. You have to know the rules. You have to know the law. You have to know how to code the receipts. You have to know how to code some of the other things, the expenses, the things that you're writing off. You need to understand how to properly document those things. So the IRS is saying, hey, if you, sir, you, ma'am, have the profit intent to make, in your business, if you are working on a regular and consistent basis, and if you have proper documentation, you can write off a lot of different things, We're going to go over those things. But I do want to tell everybody about this book, Home Business Tax Easy. When you're talking about getting some detail on some of the deductions that I'm going to go over tonight, I suggest everyone to definitely look at getting this book, Home Business Tax Savings Made Easy. The More You Know, the Less You Owe by Ron Mueller. I'm going to put a link up that you guys can also click on this. I would keep this link up the entire time. Let me get this link up for you now. Okay, I got the link up there for you guys so that you can go ahead and get that. All you have to do is hit the purchase now, and they're going to carry you directly to Mr. Mueller's site where you see a lot of information there. You might want to sign up for his newsletters and things because he has a lot of different seminars and webinars, that he gives out as well to help you. But definitely want to get this book. They have it in the paperback book. They have it that you can put it up on the iPad as well if you want to just download it. I love this book here. It's the easiest one that you can read, understand in layman's terms, but also it goes over a lot of the proper documentation that you are going to need, okay, that you're going to need. For those of you that can't click on it now, and you want to know the website to go to see it later, just jot this down: www.slashyourtaxesnow.com, www.slashyourtaxesnow.com. If you go there, you'll be able to get the book. The overview of the book goes over 6 deductions. We go over 5. We go over 6 deductions that would save you $3,000 to $6,000 in taxes per year. The 6 deductions that would save you $3,000 to $6,000 in taxes per year. I'm going to leave that link up so that you can go ahead and purchase that. Even you want to wait to the end of the webinar, you can still do so by hitting that button there and be able to get that book. Every home needs that book. Every person that has a home-based business need that book as well. Anybody that is thinking about having a home-based business need that book as well, just to see how much you can really save per year in on your taxes. Okay, let's go over these 5 deductions. Let's go over these 5 tax deductions that I promise you that you need, and it's going to tie all in at the end. So make sure that you stay to the end of the webinar as well, because I'm going to tie it all up to you. Okay, I'm going to tie it all up there to you. Okay, the first one that we're going to talk about, this is number 1. Your home is your principal place of business. A lot of you, well, Terrence, if it was a home-based business, I kind of understand that a little bit, but it's a couple of things that you must do. Number 1, you have to set it up properly. Okay, if it's a home-based business, that means the business itself is primarily based at home, and you have a certain area in your home that's designed for you to do business, whether it's to talk to customers, look at customers, or to just manage. Okay, whatever it is, that's the place for your business. It does not have to be an entire room. It does not have to be an entire room, but it does have to be exclusively for the business. So in other words, you if you have a desk with the computer, that computer and that desk have to be really exclusive for business purposes. It can't be for little Johnny and Sue to come and do their homework at every single day. No, 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 no. It has to be for business purposes. Once you set that up, okay, you can convert thousands of dollars worth of normal, non-deductible business expenses into tax-deductible business expenses. So once you have it set up, those of you that are paying a mortgage or even paying a rent, now you have an additional tax deduction, which means that if you have a mortgage or have rent and you do not have a home business, you are losing money. Point blank, period. Some of the other things is heating, okay? Air conditioning. It's the summertime right now. It's been 90 degrees for a while. I've got a little break today, but air conditioning, a portion of that can now be tax deductible. You're already paying it. You're already paying it, and you're going to pay it. You're going to pay your electricity every single month. But now you'll be able to turn it into a tax deduction. Natural gas, oil, water, sewer, even trash collection. Individuals ask me, Terrence, how in the world can trash collection end up being tax deductible? A portion of it. How is that so? Let me tell you, because if you have a home-based business and you set your office up correctly, you have your desk, you have your computer, right there beside your desk, you probably have your trash can there, because if you're really doing business there, you're conducting business. Every office that I know and outside have trash cans, because there's business form, business supplies, you got paper, you got envelopes that have been mailed to you, you're throwing that away. You got a trash can right there. It's business things that you have that you're throwing in that trash can. Well, that trash can has to be picked up and thrown away. So because it has to be picked up and thrown away, now a portion of that is now a write-off. Trash collection, same thing as recycling fees. Homeowners association dues. Now, normally, if you don't have a home-based business, you can't write off homeowner association dues. A lot of individuals try. They try to do their Schedule A form on their taxes, and they want to write off homeowners. You cannot write off homeowner association unless you have a business. House cleaning. If you are one that have individuals that's coming to clean your house, well, if they come in to clean your house, that's great, but they're also going to clean your home office while they're there. And if they are cleaning your home office, a portion of that can be a write-off. There's ways to do exterior painting, security alarms. It's not just protecting your home, it's really protecting your business. You see, your business address is just so happens to be the same address of your home. Okay, you have maintenance costs, home repairs, and much more. Intent to generate a profit, actively participate, and if you document these hours, you could potentially have major tax deductions. Okay, I want to pause now, guys, because I want everybody to actually realize that this is a question and answering webinar just to make sure. So if you have any question, I do have a question about somebody said how much is the book? It's about $39, I believe, in the book format. Now, Mr. Muter used to have it in audio. I do not think he has it in audio any longer because the tax law changed every year. And that means he would have to get that recorded or spoken every single year. So I do not think he has it in audio now. But I know that he has it so that you can download it on an iPad device or something like that. And he has it as hard copy. But I think it's about $39 for the book. Okay. And guys, remember, this is live. So if you have any other questions, that hit the question and answering button, and we can answer your questions about any one of these deductions. So if you have any questions about the home office, I'll break here, and I'll break after every one of the slides that goes over the 5 deductions. I will break after that to see if you guys have any questions that I can answer for you. Okay. Great question. All right, great question. So no questions about the home is your principal place of business. We'll go on. It is acceptable to have your mailing address for a home-based business and still be able to deduct the, yes, you can have your PO box as the mailing address. That's when you're registered. You can have the mailing address be a PO box as long as you are operating and managing the business at the home office. So as long as you're managing and operating in the home office space, that area that you design, you can have a home-based business. Your mail is just going over to the PO box, and because you have a PO box that costs you, you can be able to write that off also as a tax deduction. Okay. How big does the office have to be square footage wise? There is no stipulations with the IRS as far as how big the office have to be or area. Remember, it's not just an office any longer. It used to be an office, but it can be an area. So it can be just as big as the desk. Okay, it can be as big as the desk. I've seen some individuals that have it, sometimes they got the little desk thing near the kitchen, that little nook there. It can be that area. So it can be what, 2x4, 2x2, whatever it is, whatever, how big that desk is that you have with that computer. The key is it has to exclusively be for the business. That's the key. Great questions, guys. That's the key. Any other questions? No other questions? We're going to move on to the next one, and then we'll pause again for any questions right after that. All right. The next deduction, and this could be your biggest one. This could be the biggest deduction that you have. Your biggest deduction may be your vehicle, maybe your car. It just may be your car. Okay. I know a lot of individuals talk about, yes, I got the vehicle. Now, guys, this is most important for us record keeping. You really have to really do good record keeping with this one, but it's not hard. A lot of individuals are not doing this because they think that it's hard. And we want to make sure that you're keeping records with this one, because this is one that the IRS will audit, and they want to see your records on the miles. So let's talk about how you can easily do it, because many people in the home-based business can honestly and legitimately deduct $3,000 to $5,000 or more per year for using their personal vehicles for what? Business purposes. And that's one of the key business purposes. Then the record keeping part of it. If you keep a 90-day log, I didn't say 365 days. If you keep a 90-day log consistently, 90 days, okay, once a year, here's what you got to show. You show the date that it was, the destination where you went to, the primary purpose. and that's the key, primary purpose, and the miles traveled for each use. Now, I want to add something. Sometimes the IRS want the beginning and the ending of your abdominal reading. So make sure that you have the beginning and the ending, okay, there as well. Or you can do that at the beginning of the year, January, the end of the year in December. Or you can use the or change records that you have of individuals. And if you don't have those records, you make sure that you go to a location that you can retrieve those records, because every time they do the oil changes, they tell you how many miles on your vehicle. So you can do those things, but you don't have to do it for 90 days. Okay, that's the only records that most people need to keep. Here's how easy it is. You get into the car, you have a little sheet of paper there in the glove compartment with things, whatever, okay, a little book that you can get at one of the office places or Walmart, whatever. You just put the date that you're going, you put the destination, your primary purpose, and the miles. That's all you have to do. Okay, now here's the note. Here's the note. I want you to say this. The only thing the IRS want is the primary purpose. Okay, note that the primary purpose have to be on there. Primary purpose, okay, of each trip. I say that because if you combine a personal errand with a necessary business errand, the vehicle you use is still tax deductible. Now, as long as the personal errand did not add any additional mileage. You see, if it didn't add any additional mileage, it's okay. So let's say you need to go to Walmart. You need to go to Walmart to get some business pen. You need some ink, or you need something you need, but it's for a business purpose, for a necessary business errand, right? You have to go to Walmart. If you have to go somewhere, if you stop somewhere else on the way to Walmart, it's actually what? Still tax deductible. Why? Because it's on the way to Walmart. It didn't add any additional miles. That's the key. Now, here's the thing. When you go into Walmart, and every time you go to Walmart, I want you to start thinking that, what do I need for my business, for my home office? Because a lot of you probably go to Walmart now to get your groceries, going grocery shopping. Walmart, Super Walmart now. I want you to go to your grocery shopping, but I want you to go when you have to go and get something for your business. Because I want your primary purpose to be for business. So you go there, you get your pens, you get the paper for business, and while you are there, then you can get your grocery. But you went there for business purposes. And on your mileage log, you're going to put the date, you're going to put Walmart at the destination. Your primary purpose was to get some pens, and you got the receipt that that's on that that showed that you purchased the pen, and you got the miles traveled. You know how far it is to Walmart and back. And you just keep those records for 90 days. You keep them for 90 days, and you can multiply the 90 days times 4 to get the whole year, if it's on average doing the same thing. If you're pretty much doing the same thing the whole year, which most people are for business purposes, okay? And you can write that off. This is huge right now, because the IRS in 2016 is giving us 54 cents per mile. 54 cents per mile. Now, there's a difference between using the mileage way and then using the actual cost. You can use either or. You're going to use the one that's going to help you out the most. If you're using the actual cost of the expenditure of your vehicle for business purposes, you got to make sure that you get the percentage of your vehicle that you are using for business. You can use that by using the miles as well, and say, hey, I use my vehicle 60% of the time for business, 40% of the time for business, whatever it is. And then you can write off all of your oil changes that you have. You can write off any type of repairs that you do. You can even write off your car washes that you have. You can write off your tires. Okay. You can write off anything associated with the upkeep of that vehicle. You can write off then, but it's a percentage of the business use of that vehicle. But you cannot do both of them. You cannot do gas receipts and miles. Okay. You can do either or. Now, because they're giving us 54 cents per mile, the majority of the time, the 54 cents per mile is better. The majority of the time, the mileage is better. On some circumstances that your the actual expense is better. Like if you had a hard repair on your vehicle, you had to do something that may be better at that time. Okay, so I am going to see if we have any questions about that for a second. Okay, I do have a question real quick before we actually go on. It says, do the business purchase need to be separate from the personal purchases at Walmart? You do not have to have it separate purpose. It would be a good idea to keep them separately. Tell them that to ring up your business stuff first and then that. Okay, it doesn't have to be, but it would be a good practice to do so. Now, if you do have them to ring it all up at the same time, make sure that you highlight the business purpose. Make sure you highlight the one that you got for business. Now, why do I say do it separate sometimes? Because let's be honest, if you do get audit and an auditor see a long receipt and just see one item, they can, because it's the IRS, okay, they can say, hey, was this primary purpose for your business or was it to get the groceries? You got $300 worth of grocery and you got a $5 worth of business stuff. Okay, now you can still fight that, of course. You can still fight that because it's in the tax code, but sometimes the auditor may give you a hard time and review your expenses actually even more, but if you have it separate, it'll be a good practice of doing so. It would just be a good practice of doing so. Okay, I hope that answered that question. I just got another car. Congratulations. Will I be able to have a deductions for that? Congratulations on the car. Yes, you can. We got to see if they change the law a little bit, but there is a deductions that some things that you can do with that if your car is for business purposes and you're doing it for business or you got it for business. There's different ways. Now, a little bit more into that than this webinar covers. So make sure you email us or talk to your tax preparer. If you want to email us, you can email me directly, thawkins@hawkinstax.net. There's certain things on certain vehicles on purchases called a 179 exchange. Like last year, there's some great deductions on purchasing a vehicle. Sometimes it's a great idea to do. So some great stuff there. All right. If you financing a car, can you use the payment called insurance? Okay, that will be a part of the actual expenditures. If you have a personal car and financing it, definitely the interest expense, and then the insurance, not the whole payment, but the interest expense, and then the insurance can be on the actual. And then that's another difference if you get the vehicle in your business name, a little bit more tax planning, on what you may want to do that, and you have to weigh the additional cost for the insurance probably and the MV versus it's going to give you that much money back on your business. Those are a little bit more detail on that, but some of the things but you have to plan for them. You do have to plan for them ahead. Okay, have to plan for them ahead. Great questions, guys. Other questions, guys? We're going to continue to move on to the next deduction. Next deduction is the one I really like. Okay, hire your own children. Hire your own children. Individuals definitely need to look at this deduction that have a child. If you have a child, okay, you have a minor child or children at least 7 years of age, under 17, but at least 7 and 17. In between that's the key, 7 and 17. You are able to hire your own child for your home-based business. The child can work for the parents and they are not subject to any labor laws, okay? And the child is exempt for all income that you are paying them. No federal taxes, no state taxes. They are also excluded, exempt from Social Security and Medicare, that FICA. So they don't have to pay taxes on any other money that you pay them. The IRS 2016 give you up to $6,300 a year to hire your own child. That means you can pay your child $525 a month. $525 a month, which is $6,300 a year, to help you with the home-based business. Whether they're helping you with marketing, they're helping you with the computer, they're helping you with cleaning, they're helping you with designing, they're helping you with passing out business card, advertising, whatever it is that you're doing. And if you train them up, okay, just like you would train up any other employee, if you train them up, you do certain things. I mean, I know One time my son is 15 years of age now, and I've been using this for a while. Even if you're having a little meeting, some people have a little meetings in some of the home businesses that's out there. You have little networking meetings at your house, and you have music playing where your child can be over the music. They can be the DJ. Let them be involved. But just not let them be involved just to be there. You had them. See, stop giving your child an allowance and start giving them a paycheck. Stop giving them an allowance and give them a paycheck. It's just a difference in mindset. Now, here's the cool thing about it. Okay, you're able to pay your child $6,300 a year. They do not have to file taxes up to $6,300. They don't have to file federal, state, Social Security, Medicare on those taxes, but you get to write it off as a deduction. So you get to write it off as a deduction, and they do not have to pay taxes on the money. It doesn't get any better than that. That is awesome. Now, some of you may be thinking, well, Terrence, I don't have an extra $525 a month to give my child, whether it's allowance or whether it's a paycheck, whatever. Yes, you do. See, here's the thing. The IRS does not stipulate on what the child must do with their money or what the child must do. You have an employee. If you have an employee, that's your child, you can pay them $525 a month. It goes, you need to set it up. Make sure that they have an employee agreement. Make sure that they have a bank account of their own. Make sure that it goes from your bank account to their bank account, whether directly with a direct deposit, whether using a check or whatever. Because if you're an employee, think about it, you want to get paid and paid consistently. You have to pay your child and pay them consistently as well. They are an employee, okay? You have to, have that relationship, okay? So when it goes into their account, they got their own account, they got their own debit card and things of that nature. Now they're under the age, the banks are going to want you to be in charge of that account anyway. Just so happens, now you're back at Walmart. You're back at Walmart, you're doing your grocery shopping. Your child can pay for the groceries if they wanted to. That's at the Walmart part. You have to pay for it anyway, right? Great. But also, how about this? How many of our kids today are in sports? How many of them are in AAU sports? All different types of sports that we're in. We're in basketball AAU, volleyball AAU, flag football, Pop Warner, and those cost a lot of money. You need shoes, you need gear, you need just the cost of the organization to be in. Well, if you're paying your child $525 a month, they can pay for their own stuff. They can pay for their own stuff. I clearly remember when my son had to go on his 8th grade school trip, there was, money that had to be paid in deposit. I clearly remember how he was able to write the amounts using his own check with his own name of it. We teach him how to write checks. It's his money. He wanted to go to the school trip as well. He paid for it with his own money that comes out of his account. It was money that had to be spent anyway. So there's ways to actually do so, guys, and you can be helped doing. But this is $6,300 per child. And this is the one that I see people missing all the time. I see them missing all the time just by not preparing and planning for it. It's just preparation. There's a couple of things you have to do and just be consistent in doing so. But it can save you a lot of money per child, especially, individuals that have a child that 1, 2, 3, whatever it is, but it's $6,300 per child. A lot of money on tax savings. You have to do it anyway. A lot of money tax savings. Let's see if we got any questions about hiring your own child. No question about hiring your own child. Just make sure that you have the employee agreement in. Make sure that you have the employee agreement in. That's good to have because you want to, just let the IRS know, say, hey, no, this is an employee-child relationship. I like that because that's extra record keeping. You don't have to have it, but it's extra record keeping just to make sure, okay? Make sure that your child has their own bank account. Make sure that the money goes from your bank account, whether you're doing it in a check format or whether you're doing transfer, it goes from their bank account to your bank account to their bank account. So you can show the transaction. But this is a deduction that most people really need to start taking advantage of. $6,300 a year. They can pay for a lot of other things with that. Remember, they can even pay for their private school. That's tuition. They can pay for that. It's their own. Okay. Some of them are 16 and they're getting vehicles, they're getting cars. They can pay for their own car payment. Guys, it's just so much. It's just so much you can do with that. But this is one that we have to start taking advantage of. Hire your own child, okay? Let's go on to the next one. No question about that. Let's go on to the next one. And you can ask questions about it, and I'll go back to it. Okay. The next one, all health costs for your entire family can be tax deductible. Notice the word all, and notice the word entire. All health care costs can be for your entire family can be tax deductible. Let me go over this a little bit because some of you are currently maybe getting some type of benefit on your taxes for healthcare costs. That's located on the Schedule A form right at the top where it says medical and health and dental, things of that nature. But here's the thing, okay? You are able to get those deductions, but you can only deduct healthcare costs that exceeds 10% of your taxable income. That means if your taxable income is $40,000, if your taxable income is $40,000, you can only start writing off the things that are above $4,000. So let's say, example, you have healthcare expenses of $5,000 and your taxable income is $40,000. 10% of the 40,000 is 4,000. That means you're only going to get $1,000 as deductible because the first $4,000 is non-taxable, all because, okay, it's on the Schedule A form because it has to exceed 10%. But if you own a home-based business, okay, it gives you an IRS approved option for writing off all non-reimbursed health costs. And it applies to all members of your immediate family. And there's a couple of ways that you can do so. I'm just going to, for time, I'm just going to go over one of them. Well, one of them is is basically hiring your own spouse, and it's a very good deduction. 100% of reimbursements, guys. It's really, really awesome. Okay, health reimbursement agreement is what it's called. It's huge. Okay, but for this one, and on the time save, we're just going to go over the simple one. We're going to save you that first 10% of the monies that's not able to be deducted. And a lot of individuals are not deducting it because they're like, you know what? I do not have that much in healthcare costs. If my taxable income is $50,000, I'm not paying $5,000 in healthcare expenditures. And you're telling your tax preparer, and that they like, well, you can't write that off. And you're like, why? I spent $2,000 on my premiums and whatnot. Everybody has to have healthcare. I thought I can write it off, but it said, hey, the first 10%, you can't. It doesn't benefit you. But if you have a home-based business, it will benefit you, okay? Because that's line number 29. If each and every one of you want to pull out your old tax return and look at line 29 and just read what it says. Line 29 on the first page of a 1040. It talks about the healthcare insurance deduction. It talks about that, okay? So coverage can include insurance premiums, annual deductibles, co-pays, non-covered expenses like orthodontists, etc., natural or holistic remedies, and even over-the-counter drugs. Okay, so there's ways that you can do all of that. But this is the first 10%. You need to start writing all this, and this can be huge because if you're paying $200 a month, even if you're using the Affordable Care Act, even if you use that now, you can start writing it off. $300 a month, you can start writing it off. Huge expense that you can get for that. Let's see, we have any questions actually for that one? No questions for health care. Just remember, this is live question and answering. If you have any questions, we'll be able to go over those questions today while you're on the webinar. Okay, while you're on the webinar. We do have one coming in here. Does this apply if you are a W-2 employee covered by an employer plan? Okay, very good. If you are covered by an employer plan, the amount that you are paying, not the amount that your employer paying. So if you have an amount that you are paying for your insurance, you can write off that amount. So if your portion is $100 a month, you can write off the $100 a month. That's $1,200 a year, okay, that you can use there. But also remember your copays that you have. You may still have copays. Remember, then there's another agreement that you can do natural remedies. So a lot of individuals, if you're all into minerals and vitamins and minerals and nutrients and things of that nature, you can start writing those things off. There's some individuals that are in have a home business for health businesses and stuff that have minerals and nutrients. You can start writing those off as a tax deduction. I'm unclear on how to deduct with health insurance. Okay, all you need to do, just to keep it simple, okay, if you're unsure or unclear about it. There is a deduction for health insurance and the medical. Currently, if you do not have a home-based business, you are able to write those things off, but only the amount that's over 10% of your taxable income is counted to help you. So the first 10% you do not get credit for. So if you have a taxable income that goes by your wage of $40,000 a year or 50,000, but I'm going to use $40,000 a year. That means the first $4,000 of all of your health expenditures, including health insurance, is not tax deductible currently. However, if you have a home-based business, there's a specific deduction that will allow you to count all of it, including the first 10%. The first 10%. So you do not lose the first 10% of that deduction. A lot of people are losing it because they do not have a plan. Okay. If you need any other type of further explanation, just email me, thawkins@hawkinstax.net. Okay, thawkins@hawkinstax.net. We have another question. If the kids are under 7 years old, do they have to be your kids? Yes, they need to be your kids. They can work for their parents and have that. If they work for somebody else, they're going to get taxed. Okay. If I have a health savings account through my employer, can I still write out the funds used for my health expenses? Yes, you can. If the amounts that you pay, and stuff, and it'll figure that out. Okay. But the amounts that you pay, a portion of it can. All right. Sounds good. Let's keep moving on, guys. For time purposes, we almost towards our hour part. All right. Family trips. Family trips. If you plan them correctly. Okay, family trips, if you plan them correctly. I see a lot of people that do not plan them correctly, but if you plan them correctly, you can write them off as well. Okay, see, if you know the rules, you can combine business with pleasure, and mostly pleasure if you're having fun. Okay, and can usually deduct 100% of your hotel, 100% of your ground transportation, 100% tips and gratuities, and 50% of your meals, all as business expenses. And I definitely want you to get Ron Mueller's book for that. Definitely want you to get the books for that to make sure that you're doing that the right way. Because it says if you know the rules and you combine business with pleasure, you can. My job is to tell you that you can if you plan them correctly. Okay, even if most of your time is spent playing and sightseeing with your family per day, you can do that. Okay, here's the thing: to qualify, more than half of your days away from home need to qualify as business days. And that's the key, not long business days, business days. So what's a business day? Business days or travel days usually count as days usually count as business days, as do any days you attend what? A pre-scheduled meeting, no matter how brief. So if you plan them correctly, and if you have a pre-scheduled meeting, especially to meet with a client, to meet with a customer, to try to some of the business to recruit, try to evaluate, whatever it is, the key is planning them, ahead with a pre-scheduled meeting and some other things, activities. Okay, no matter how brief they are, 10 minutes, 15 minutes, 20 minutes, whatever it is, pre-scheduled meeting, okay, no matter how brief, can end up being a business day. And if you have more business days than just pleasure days, you can potentially write those trips off. Make sure that you get the book to cover that. Make sure that you get the book to cover that. Okay. All right. Questions about that one? Let's continue to actually go on, guys. Now, actual cost of running the business. We're almost towards the end. Actual cost of running the business is the last one. And a lot of people forget this one. And the rule of thumb is this: any expense that you incur because of your business that you would not have incurred if you didn't have a business is probably deductible. Again, any expense that you incur because of your business that you would not have incurred if you didn't have a business is probably deductible. One of those things is startup costs. Do you know that the IRS give us up to $5,000 to start your business? Meaning as a tax deductible, that is. So if you're spending money to consider what business that you're trying to get. You're going to different meetings, you're going to different places, you're evaluating the market. You got to get your a computer now, you got to get a phone now, you got to get the internet now, you got, all those things can be startup costs. Up to $5,000, up to $5,000 of all of that is now tax deductible. Your promotional materials that you're getting, whether it is shirt with the logo of your business cards, anything that you need to run a business is a promotion. Your product samples, a lot of businesses actually that you're getting, you got to get samples, especially if you're in a product company, to give out. They're now what? They're now tax write-off. Meeting attendance, if you're attending meetings, write-off. Internet access. You see, if you're online now, you're using the internet to learn about the business. It's the only way that you can learn about the business on today is actually looking at the internet or, customers, this nature. If you have the internet or data plan on your phone and you don't have a business, you're losing money. It's stuff you're already doing. You're already doing that. Your phone service, fax lines, leads list, if you're buying leads, website fees, okay? If you have a website, most companies, a lot of companies have websites. That's 100% tax deductible. Write it off. 800 numbers, printing costs, briefcases, business cards, office furnishing. If you have that all-home office that we was talking about, and you got to put a new desk there, a new chair there, 100% write-off, and much, much more. Because we need to talk about, organization costs. If you want to organize, organization, I need an LLC, I need this and that. For all of the legal fees of that, attorney fee, that's an additional $5,000 in total write-off for organization costs that you can write off. Huge deductions there. The main thing is you can write it off. You can write it off. Okay. No other questions there about that. We're going to actually move on, guys, because we have gone through the 5 now. Let me go over how it works. I'm going to tie all of this into you guys, and we're going to let you go. Hold on. Let me tie all of this into it. Here's how it works. Let's put some numbers to this stuff, okay? Let's put some numbers to it because actually we've gone over that for 5 deductions, but let me put some numbers to it and tell you why you need to actually start planning your own business now. Number 1, home-related business expense. We went over all of the deductions of the home-related business expenses, and let's say that at the end of the year you have $1,200 in a deduction for that, okay? And we're looking at the percentages and things of that nature. Now, wages for hiring your child. Remember the $6,300. Let's say you got 1 child. And if you do not have a child, you just take this one out, okay? If you have a child, you can put this one in between the ages of 7 and 17. And if you have 2 or 3, you just multiply that, right? So 63. Families non-reimbursed medical costs. I'm just going to do the first 10%. The first 10%, no extra stuff. That's the first 10% that you're not currently writing off. Never going to be able to write that off. And I'm going to use 5,000 because the average of Americans make $53,000 a year. So that's an additional $5,000 in deduction just for your medical, okay? Vehicle business miles, remember it's 54 cents per mile. I'm going to use 13,000 miles on the average a person drives. And I'm going to say that 60% of that is business miles. Because it's not going to be 100% of your vehicle miles is not going to be business miles, guys. Okay, it's not going to be business miles. But let's say 60% is business miles. That's 7,800 miles, business miles at 54 cents. That is over $4,212 in deduction for that. See how big it is just by your car. Okay, business travel. Your family trips that you're taking. Let's say it's just $2,000 a year. I want you to look at what you currently call a vacation and things of that nature. We can show you how you can do that into business trip. Get the book, okay? It's huge on that subject. 50% of business meals and entertainment. We didn't really go over that, right? But we're going to talk about it. Meals and entertainment. Let's say that an additional $1,500. We can talk about how you can do that. Other deductions, business equipment, cell phones, supplies, cost of business, etc. Let's say that's $2,000 for the whole year. So when we add all of that up, that's $22,212 for the entire year of an additional deductions that you normally did not have. That means if you were getting taxed on $50,000, if your taxable income was $50,000 a year, you're going to get taxed on $50,000. But the deduction reduces the taxable income, and in this case, it's $22,212 that it reduced it. Okay, so you're getting taxed on a whole lot less by you the tax deductions of stuff that you're currently already spending money on anyway. All these things you're currently spending money on this, you're just not getting a deduction. Now, if the average tax rate is 25%, okay, state, federal is 25%. When you look at that 25%, the average person, 53,000, that's a savings of $5,553 a year. $5,553 a year. And guys, I was very conservative with these numbers. I was conservative with these numbers, and it's $5,553 a year. That's a lot of money. So what does that mean, Terrence? That means, let's say you got a $1,000 refund this past year. Let's say that you receive a $1,000 refund this past year. That means potentially you could increase that an additional $5,553. That makes it $6,553 in a refund. Well, let's say you owed $1,000. If you owed $1,000, there's still an additional income. So now there's a refund of $4,553 in this example. Basically, what I'm trying to get you to know is it's real money. It's real money at the end of the year. It's real money. Now, here's the part that's very good, that helps individuals out, that's living that month to month and they're tight, okay? The month to month and they're tight. Because we want you to understand that you do not have to wait until April the 15th to get your refunds. That $5,550, let's give it $5,553, you do not have to wait till April 15th to get it. Do you know that the IRS say if you have a change in tax status, that you can go to your employer and you can change your W-4 forms? You know, some people change it, went on to get bonuses, right? Get bad time to do that, guys. Talk to your tax preparer about that, all right? But you can go back and change it, because now you're saying, wait a minute, I have extra deductions and I'm not going to get taxed on all of my money, so I need you not to give the IRS, you know, additional money for estimated taxes via my W-4. So, you know, W-4 is that form that you do single, one, married, two, when you're actually working. You can change that. The higher you go up in number, the less that they take out. If you're going to get a refund of $5,553, no, don't get a huge refund. I do not like my clients to get a huge refund. Why? Because you just gave the IRS a free loan. A refund is you gave us too much money, we're giving it back to you. Don't give them $5,553 in extra. You can now change the W-4 and start getting that back now when you need it. That's an additional $462 a month coming back additional on your paycheck, and you can utilize that money. And you can do that in this example because you will have a home-based business. Home-based business, guys, is absolutely huge. You do not have to wait to April 15th to get that. And the thing I like about that, guys, is this question. The question is $300 to $600 a month enough money to cover the cost of running a home-based business? And the answers always range from yes to yes, especially a lot of the direct selling companies, you know, that's home-based businesses, network marketing companies. It's more than enough. The example that we just did together was $462. Most of the companies definitely less than that per month to operate and run a business. So here's the exciting part about that means. That means a portion of that money can cover the cost of running the business. So everything else is simply profit, additional income that you can use, additional income to use. That means every commission then is pure profit. Every bonus that they have is pure profit. I really like this. And you're still saving a lot of money on your taxes. These 5 deductions are huge. You just have to position yourself to get them. Now, let me give you fair warning. Fair warning is the cost of procrastination is absolutely huge. The cost of procrastination for waiting is absolutely huge. You just heard the information on tonight. I want you to understand, every day that you do not have a home-based business, you're pretty much losing $10 to $20 a day in tax savings on average. On average, $10 to $20 a day lost in tax savings. So I need to put a visual picture in your head for you, okay? I want you to think about yourself getting up in the morning and you're going to work. You get up in the morning, you're going to work. And I want you to think about that stoplight that you stop at every single day on your way to work. That stoplight. If you don't have to stop at a stoplight, think about your stop sign. Wherever you stop at, think about that same place. And I want you to picture yourself at that stoplight I want you to reach over, get a $20 bill, and I want you to just throw it out the window. I want you to just throw it out the window. Because I want you to see that you're throwing away $20 a day. Well, you're not throwing it away, it's going to the IRS. But it can stay in your pocket. It can stay in your vehicle with you, but you're throwing it away every day. So tomorrow, I want you to see $20. If you do not get a home-based business by tomorrow, $20, throw it away. Then the next day, another 20, throw it away. The same stoplight, throw it away. The next day, throw it away. How many days can you go throwing away $10 to $20 bills out of the window? Do not procrastinate on this. Do not procrastinate on this. Okay, get set up actually with a home-based business to start taking advantage of the deductions that you can take advantage of. Now, a lot of people do ask me then, Terrence, when I go all around the country and I'm doing the seminars, they do always ask, well, what business should I get? What business should I get? Should I get this? I like to do this. I can like to do this. Guys, there's a lot of businesses out there. I'm not here to actually tell you what business to actually get. There's a lot of different businesses out there. I do have a model that I fit in. I do use the same strategies that I'm teaching you tonight. I use them myself. And I always have made the custom that the businesses actually I choose, number one, I like the startup costs under $200. That doesn't mean that you can't get into a business that costs more than $200. I'm not saying that, but I do like the ones that cost less than $200. If you're using it for tax purposes, less than $200 to actually get into a business. It does cost to get a business. Okay, it does cost, and then less than $100 a month. Less than $100 a month. There's normally a cost to any business to run any business, and IRS do look at that. Are there regular costs in running a business? Do you have a website fee? Do you have, the different trainings or whatever? So most businesses do have a monthly fee. I look for under $100 businesses to get into, and I look for the residual income. I look for residual income, building income. I really like the matrix, things of that nature. So what business that you should get? Pick the one that you're comfortable with, okay? But I do look for the ones that's under $200 to start, under $100 to operate, and because you can always save one of those tax deductions can probably cover the cost of your monthly expenditures. I do know a lot of times that your vehicle would cover $100 or less businesses, so everything else is totally profit for you. Okay. Now I want you to continue your education. I want you to continue your education. Make sure that you get the free newsletter. Get the free newsletter. If you hadn't signed up for the free newsletter, go to www.hawkinstax.net, hawkinstax.net. Get the free monthly newsletter. There's a lot of articles. I want you to continue your education to reduce your taxable income so you can pay less on your taxes. A lot of different strategies that's out there. This is a one that can help most of the people that is out there. Also, like us on Facebook. Like us on Facebook. Go to Hawkins Accounting and Tax Service on Facebook and like us there. Okay, like us there as well. But definitely want to get that free newsletter so that you can get some reminders every single month and some other tips actually that I give you. And you also get notification of when I do additional webinars on different subjects that's coming forth. Okay, we're here to help you to slash your taxes, and we want you to do them now. We're here to help you to slash those taxes. I want you to do them now. I want to thank each and every one of you for getting on the webinar. I am going to hang out just a little bit to answer some more questions that you may have towards the end of it. We'll try to stay on a little bit longer to do that for you. But those that do have to get off, I do want to thank you for joining us on this webinar. Get the newsletter, get signed up for the newsletter, and I will talk to you on the next webinar. So let's see if we have any questions. We do have a couple questions come in. When is next webinar? So I'm glad that you did enjoy it. We hadn't scheduled the next webinar because I hadn't put down the subject of what we're going to cover on the next webinar. But if you are signed up with the newsletter, you will get notification of the next webinar that I send out to everybody. We continue to educate people on that. Okay. Thank you for that. Can I share this information with my friends and family? Yes, we want you to share it. We want you to share it as much as you can. Definitely forward to individuals. We would have a link on YouTube. It has been recorded. So because you did register, you're going to get that gift. Should be in the email format within 24 to 48 hours. You should be able to we will be emailing that link out so you can share it with your friends and your family as well. Okay, so that's going to actually be coming out. Any other questions, guys? We are open for any questions as I get me something to drink here. Been talking a little bit longer. Thank you, Terrence. Great and forward. Thank you for sharing. You are so welcome. You are so welcome. It's my pleasure. My pleasure. You know, the question, those of you that do have to leave, definitely get that book. Make sure you get that book. You still should see it live up there, but make sure you get the book. Any other question? We'll go a couple of minutes and see if we got any questions. No other questions. We're going to end it, but I'll give you a chance to answer any questions that you may have. All right, all right. The month you're still on, Elizabeth, welcome to the webinar. Thank you for actually joining. Derek, thanks for being on as well. Leon, again, thank you. Malik, thank you for being on. Do appreciate it. Do appreciate it. Hope you guys got some good information for that. Oh, God. All right, guys. If no other questions, I don't think anybody have any other questions here. Thank you so much. You're welcome, Elizabeth. All right, very good, guys. If no other questions, guys, I officially want to actually thank you then for actually being on the webinar. This broadcast then is officially over. I see you on the next webinar. Take care, guys. Goodbye.